why don't we go ahead and jump into the presentation? And I think it's time to get started with the proverbial risk disclosure. So we don't need to read every word of this out loud, but do take a moment to read what's on your screen. And I think the key element here is that there is risk of loss in trading futures and options, or really with any investment. Past performance is no guarantee of future results, and that all funds committed should be purely risk capital. Here we go. A little scene from Trading Places. We're going to jump into futures contracts. They're the Duke brothers teaching Valentine about commodities for breakfast, coffee, and sugar, and orange juice. So if you haven't seen that movie, you can't really trade without it, right? It's sort of a rite of passage. So moving along with commodity futures products, the ingredients of life. As you know, commodity prices are impacted by various factors, multiple variables: supply, demand, weather, politics, rumors, transportation costs. So what is futures trading? Well, futures trading tries to take all those factors into account ahead of time so that prices become more predictable and consistent by the time the product reaches the market. And that saves us money. That's the whole idea of the futures markets: price stability. And businesses can use futures to hedge and navigate their risk by locking in prices now, trading futures contracts. So let's look at some examples, and let's look at a hedge. There's a cattle rancher concerned about lower prices, and that rancher could use the futures markets to attempt to minimize their price risk. So right now, the rancher could go short or sell live cattle futures and lock in a sales price for the cattle herd that they intend to sell months later, so that even if prices did decline, they would have locked in a sales price now by going short futures contracts. So for example, feeding cattle in August, expecting to sell in December, the rancher could look at December cattle futures trading at 125 and then go short a contract at 125. And if you're not too familiar with going short and going long, don't worry, we're going to cover that. So in December, the cattle rancher finally sells the herd, and at the same time will buy back or cover his short futures position. And then if cattle prices at the time are lower, of course, he would make less money on the herd that he sold, but he would have gained an equivalent amount on his short futures position. And then, of course, if cattle prices were higher, the opposite would happen. He would make more when he sold his herd for cash, and he would lose on the futures contract. But either way, he knew in August that combined, the two transactions would generate a sales price of 125. And so that's what this looks like here. Let me grab my highlighter. So in August, the cattle prices are at 125. In December, they had slumped to 115 when he sells, so he loses $10. But in December, remember, he also went short futures at 125. And then, I'm sorry, in August, in August he went short. And then in December, he covered that at 115. And so that's a net gain of 10, and that together combined equals a wash for a net gain or loss of 0. And that's the whole premise or whole intent of a hedge, is to simply cover your risk and not speculate and attempt to make a profit. All right, very good. So who attempts to make a profit? We do, speculators, accepting the risk being transferred with the intent to profit by buying futures and then selling them later, or selling futures contracts and then buying them back later. So we are speculators, along with market makers, hedge funds, proprietary trading groups, money managers, portfolio managers. Those are the speculators. All right, very good. Let's look at some futures contracts. What do they look like? Well, they represent a specific quantity or value. They are bought and sold at a specific price and specific date in the future. And this is a really important component here. It's a legal agreement to buy or sell at some future date. And the key word is future. And they transact on regulated trading exchanges across the globe. So what does that look like? Well, here's a specific quality and quantity of, for example, gold. Gold might represent 100 ounces per contract of the same quality of gold, so therefore it's interchangeable, or what they call fungible. Remember, with futures, you can buy a contract first and sell it later, or you can sell the contract or take a short position in the contract and then buy it back later. In either order, it doesn't make any difference. So as a buyer, the buyer is said to be long the market, and the obligation for the buyer is to basically buy the commodity or take delivery of the commodity. And the risk is that after you buy it, the price of that product declines. And the reward, of course, would be if you buy something and the contract price rises. Now, looking at the seller is said to be short the market, and they are contracting or have an obligation to sell or deliver the commodity. And their risk is that prices could rise between now and that time. But of course, the reward would be if they go short and sell and then prices decline, that is their potential for reward. Now remember, don't worry about making or taking delivery. We are not going to end up with commodities in our backyard. It doesn't work like that, or you won't be required to drive a truck full of crude oil somewhere and make delivery. All contracts expire for physical or cash delivery. Cash settlement, like the S&P 500, is cash. And speculators, that's us, we will offset our positions before what's known as the first notice day or last trading day. So if you bought, you then simply sell the same contract and quantity to offset your obligation. And if you were short, you'd simply buy the same contract and quantity to offset that obligation. Just that simple. What does an order look like? What are the elements of a futures contract in placing an order? Well, you need to know if you're going to buy or sell, the quantity, the month of the contract, the market being traded, the price, and the type of order. And if you're not familiar with that order type limit, it just simply means at a specific price. So don't worry about if that's not too familiar for you at the moment. And here's what an order might look like on a typical screen where someone might have a brokerage account with a futures brokerage firm trading futures contracts and futures options. Quite simple, just the buy or sell, the quantity, the symbol, the month and year, and the order type, and then of course the price of the order. Now remember, with futures, small moves have a very large impact because the contracts are leveraged. So let's say December gold's trading at $12.50 per ounce. Well, that represents 100 ounces per contract on this particular COMEX gold contract. So that's $125,000 worth of gold in one contract. Now what happens if that price moves up, let's say $1 to $12.51? Well, that represents a $100 favorable or unfavorable result, depending on if the trader is short or long. So pretty simple, really. Now here's a key thing to remember, that margin works differently with futures compared to trading stocks. There's no such thing as borrowing money or stock or paying interest to the brokerage firm. You simply buy or sell and take a position long or short with a futures contract, and all you need is what's called the initial margin deposit. And the key word is deposit. It is not a cost. It's usually 3 to 10% of the contract value. And there's something called maintenance margin. We're going to look at that here. This is not money that's additional to the initial margin. So how does this work? Well, the value of your account is adjusted each day based on the change in the total value of the contracts that you're trading. And remember too that initial and maintenance margin may increase or decrease at any time as determined by the exchange. And usually market conditions will result in any change being made. So here's an example. Gold initial margin, let's say it's 37.40 and the maintenance is 3,400. So what does that mean? Well, if the available cash in the account falls below the 3,400 maintenance level, there would be a margin call. And then you'd have to deposit money to bring the account back to the initial figure or limit risk by closing out positions. So very simple, and that's kind of the concept for margin when it comes to trading futures contracts. And for example, what are those contracts? I'm sure many of you are familiar with these, but just a few examples here. Precious metals on the COMEX like gold, energy markets, crude oil, natural gas, unleaded gas, heating oil. There's corn and the grains and soybeans and bean oil. There are financial markets like treasury bonds, bills, notes, euro dollars, and currency futures are a big one. Euro currency, the pound, for example, the yen, and the S&P 500 would be a stock index future market, and that's one of the biggest markets out